boy. You know what, popular investor? One thing you'll learn about me is that you never, ever criticize me. Woo! Welcome back to Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And apparently, I just got wrecked by none other than the popular investor. Self-named, or is he actually popular? I don't know. Just like Strongman, but I'm strong. Anyway, so I haven't had an opportunity to watch the video. I know, very sad, very disappointing. But apparently, I guess he didn't seem to like my Amazon analysis. Now, let me explain to y'all my strategy, okay? So what I do is I try to make as much money as possible, and I funnel that money into tax advantage accounts, and I buy the Vanguard Total World Stock Market Index Fund. Why? Because I'm a boglehead, and I dedicate 5% of my portfolio to buying individual stocks that I think are undervalued. I'm driving by college right now. There's girls everywhere. Anyway, that's my strategy. Now, I'm an accountant by trade, so my specialty, my expertise, is in analyzing financial statements and doing taxes. And don't ask me to do an audit, because I'm not going to do a freaking audit. I hate audit. I took the exam, hated it, never doing it again. Anyway, that's my expertise. Now, the accounting fields and the finance fields do interact. So, finance is more forward-looking. How do I place a value? How do I assign a value to an investment? Whereas accounting is all about recording past transactions. But there are some similarities. Now, when I first started looking into stocks, individual stocks, it was March 2020, just like everybody else. Before that, I didn't even know how to buy an individual stock. And I discovered this channel called Everything Money, and I saw they had a discounted cash flow analysis tool. And I said, I wonder if I can make that myself. So after some prodding and pulling and screwing around, I was able to figure out how they calculated it. And that tool that I have, that I use on my channel, is basically theirs, but a lot uglier. And I was able to do that because I know all about the time value of money. And I learned that with freaking bonds. I didn't do accounting for bonds. That's why I learned about the time value of money. So I never claimed to be a stock genius. However, I think I do have a rational approach to picking stocks. And when you look at Amazon, I see it's one of the largest companies in the world by market capitalization. And price targets are all over the place. Now, the only way I can value that company, or I know how to, is by using a discounted cash flow analysis, using GAAP, or free cash flow. Currently, my model, it has a cash flow analysis portion, but I need like good numbers. I don't know where to freaking find them unless I do it myself, which is freaking pain. So right now I've been looking at companies solely based on GAAP earnings and seeing what point I would buy the company to get a 10 or 15% return. If I'm being nice, I say 10%. If I'm actually thinking about something that I would potentially buy, I would want a 15% return because it really builds in a margin of safety. Now looking at Amazon, $1.5 trillion market cap, and there's so much attention on it already, I just don't see how there could be that much mispricing in Amazon. So Amazon stock price is what, $2,400 right now? My model said it was worth like $1,000. Maybe that's completely off, but I also think it's just as unlikely that Amazon is going to be worth $3 trillion, or that's its current intrinsic value. Because it's really strange to me, when you have a stock that everybody's looking at, are there really that many opportunities to make a massive return? I would say there's very few, because so many different people are looking at it. There's so much attention on that stock that the price that it's currently at least in general, will roughly reflect its intrinsic value. And of course, that could be wrong too. Maybe a lot of people are missing the true value of Amazon. But the more eyes that are on a stock, usually, in my opinion, the less likely you are to make money. Now, the one exception to that is La Tesla, which there's a lot of eyes on Tesla, but That stock's a freaking joke. So anyway, I haven't watched his video, but I'm curious to see what he talked about. Now, I'm not going to bash him, and I'll tell you one reason why. He actually knows how to construct discounted cash flow analysis. He actually knows how to analyze stocks, which is a breath of fresh air on freaking YouTube. Because you look around at all these freaking clowns, and they have literally zero understanding of how stock valuation works. I'm not saying I'm the biggest genius in the world at stock valuation, but I was able to figure out, a very, very simple model just by copying everything money. It's really not hard if you understand the time value of money. But most of the people out there are total freaking morons and have no idea what they're doing. So, I don't think Amazon is a buy, in my opinion. I could be totally wrong. But at the same time, rising rates, Amazon's earnings disappointing, maybe it's got more room to fall. I don't know. And I'm also worried, if you look at all these big, large cap growth stocks, all these stocks have blown it out of the water over the last 10 years. Maybe it's for a good reason. Maybe it's because there was a lot of euphoria in US tech. I don't know. But the last thing I want to do right now is buy all these large cap tech stocks. And is Amazon tech? I guess it is with AWS. It's a tech, online retailer, whatever. The last thing I'm going to do is buy all those freaking stocks, especially when they're trading at such rich valuations. What is Amazon's PE? 60 something? Like, that's freaking nuts for such a large company. And I would not be surprised if their revenue growth going into the future is a lot less than people expect it to be. Because at a certain point, these companies have to hit a brick wall. They cannot grow 20%, 30% forever and ever and ever and ever. Especially when our economy's growing at, just a couple percentage points after you factor in inflation, like real GDP growth. I just don't see it, but that's me. So I'm curious to see what he said in his video. If there's a flaw in my tool, well, then there's a flaw in Everything Money's tool too. But I'd be curious to see what that flaw is. If he just disagrees with me based on, revenue growth rates and whatever, that's fine. I'm not going to get mad about it. I mean, maybe he's right. Maybe I'm wrong, but I'm not buying it. Now, one thing I did briefly skim his video. I couldn't listen to it because I would get in trouble. But he seems to be using enterprise value and EBITDA. Now, EBITDA is a very interesting metric. As an accountant, I have a preference for GAAP. I'm just biased, okay? EBITDA means earnings before interest, taxes, depreciation, and amortization. Basically, it's subtracting out interest expense, tax expense, depreciation, amortization to get a certain kind of, profitability metric, which is just very odd to me that you would subtract out depreciation. You're adding it back to the net income, but it's really odd to me that you would get rid of depreciation and amortization and interest and taxes when you're analyzing a stock. Because when you think about it, under generally accepted accounting principles, let's say you buy an asset. I know you're getting bored. Is that better? Under the generally accepted accounting principles, when you buy an asset, you record it on your balance sheet as an asset, and you depreciate it over its useful life. You buy a car, 5 years, whatever. You buy a building, 20, 30 years, whatever you think its useful life is. And that depreciation expense, which you're basically ignoring in EBITDA, is reflecting the cost of that asset over its life. Because if you buy a building, and let's say you pay $1 million for it, and you put building expense for $1 million, well, you're going to be using that building for 20 or 30 years. Why would you expense it all when you're going to be using it to produce revenues over the next, 10, 20, 30 something years? That's why they have the matching principle in accounting, because companies can really manipulate their earnings by, it's a building expense. So that's the whole point of that. So it's just really odd to me that you don't factor in depreciation and amortization and interest and taxes. I mean, at the end of the day, when you buy a business, when you buy a building, let's say I start my own business tomorrow and I pay $1 million for a building. That's an expense, okay? And yeah, even if I don't pay the $1 million now, it's still a freaking expense over time. It's not just a one-time expense. You got to pay for the freaking building. Same thing with interest and taxes. Why would you not look at interest and taxes? Interest is a business expense. Taxes is part of your business. What you get from your business is your earnings after you've deducted all your interest and taxes. So why you would get rid of that in that metric makes no sense to me. I don't know. Maybe it's an accounting thing, but that's just how I feel. Anyway, I'll watch the video. I mean, maybe he's onto something. Maybe I'm just totally freaking wrong. Maybe I'm an idiot. But we'll see. Still not buying Amazon. Talk to you later. Cheers.